Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Today I just want to briefly go over two big announcements from the Bank of Canada that happened over the past few days. One concerning their interest rates and the other concerning the pace of their quantitative easing program. And then I want to go over some of the implications for that, both for your mortgage rates and for the economy in general. And then we'll end off with some brief conclusions. I don't know about you, but I've been definitely looking forward to this debate that's going to be happening tonight at 9 o'clock, where the three main parties, as well as the Bloc Québécois and the Green Party, will have our first English-speaking debate. So we will have an update if anything real estate or mortgage or interest rates or monetary policy are listed or are covered in the debate. We'll have a video out for that. So make sure you click subscribe to get those updates. But for now, let's jump into the Bank of Canada's announcements. Yesterday, September 8th, the Bank of Canada announced that it will be keeping its key policy rate at 0.25%. This move was widely anticipated, and pretty much everybody figured that they wouldn't be raising their rates, mostly because of the GDP data that came out last week, which noted that our economy had actually contracted. It had shrunk. Which was a big surprise to everybody, especially during an election. You don't usually expect to see bad numbers for the economy, but nonetheless, they are what they are. So the Bank of Canada is going to keep interest rates low as a means to encourage people to borrow, to spend, and to invest. Within minutes of the policy rate coming out, I actually started receiving beeps on my phone and emails coming from all of the banks. Well, not all of the banks, but a lot of the banks, a lot of the mortgage lenders, offering specials on variable rate mortgages. Variable rates aren't that big of a risk for the banks and the mortgage lenders, as if the Bank of Canada does raise its policy rate, then it's likely that your rate will go up as well. But with that said, with the Bank of Canada keeping their rates low, the banks want to encourage those variable rates, so we can see like a direct effect between the Bank of Canada's policy rate and the rates being offered on the variable rate mortgages. The second announcement that came out yesterday and was reiterated today in a speech by Tiff Macklem, the speech was in French, but the text was released by the Bank of Canada, is that they will be continuing with their quantitative easing program. What is of note, though, is that they're not strengthening it. They're not pulling back even more than they were before. So on their quantitative easing program, they're buying right now $2 billion worth of bonds from the banks which buy them from the federal government. Without going through all the steps, suffice to say that they're buying $2 billion worth of government debt every week. They had been buying $3 billion up until a few months ago, and before that it was $4 billion. So as the reopening started to go well, and as the economy started to open back up again, the Bank of Canada was tapering in that it was lowering the amount of economic stimulus that it was providing. However, with the release of the GDP data and that our economy isn't as strong as everybody thought that it was, they are still continuing their tapering path, but they're not strengthening it. They're not moving down to, say, $1 billion a week. So we're definitely not out of the woods yet, economically or monetarily, and definitely not with COVID, as the numbers seem to be showing. But that's a discussion for another time and probably another channel. This is real estate and mortgages. But suffice to say, for now, they won't be cutting their monetary stimulus at any time soon. So they're going to keep on buying our government debt and keep those printing presses going. This also comes on the heels of weak data in the U.S. The U.S. posted just over 230,000 new jobs when it was expected that they were going to have 750,000 new jobs. So we're really seeing weak economic data from the U.S., which is usually a good indicator of what the economic data is going to be happening in Canada. Whether it be a few weeks or a few months later, they're usually a good general indicator as to where our economy is heading, and the Bank of Canada very well knows that. So they've kind of taken a play-it-by-ear approach, the wait-and-see approach, as to whether or not they have to ramp back up the quantitative easing, the economic stimulus, the buying of government debt, keep with what they've been doing at the $2 billion per week, or hopefully lower it in the next couple of months, couple of years. But I mean, that remains to be seen. So this is really a good news and bad news for the general public. Good news in that rates are going to stay low for the foreseeable future. We initially had planned on raising rates in 2022, but weak economic data doesn't bode well for interest rates. With that said, inflation data is creeping up as well, which isn't good news. Last inflation results were 3.7%, and we did a video on that as well. So we have weak economic output as well as higher inflation. Generally, well, not generally, but it can lead to stagflation as it did in the 70s and 80s. That's definitely not a good sign to see. But I guess the good news is that your interest rates will be staying low, at least for the foreseeable future. So that should make it easier to service some of that debt and make borrowing costs a little bit easier as well. Hopefully, some of these policies will be brought up tonight during the debate, which starts at 9 o'clock. I think you can stream it live on YouTube and also CBC. But if anything to do with the Bank of Canada policies or real estate does come up, we'll have an update out that in a video tomorrow. So thanks for watching, and we'll see you soon.